because that's the choice. But in ETF, it's like 0.1, 0.15%, so it's negligible. But then, is it wise to invest into all the ETFs? Well, no. In ETFs, as I mentioned before, you have to consider a few things. First, expense ratio, you have to look which is low. Second, liquidity. As I mentioned, infra Bs, that is dealing with infrastructure companies of ETF, it hardly has a lot of liquidity and volume. So the difference between buyer and seller is too huge. So for you to go over there, it could be a little risky. Even though you believe that yes, real estates and infrastructure could be the future, it could be risky. But if you believe that India as a nation is going to grow, it's going to prosper, it is having a bright future, I would insist you to invest into Nifty Bs. As simple as that. If you feel banking sector is going to outperform, place your bets on banking sector. If you feel that some mid-scale companies or emerging companies can actually outperform into the market, you go with junior Bs. The best suggestion would be mix all these three along with gold Bs, so you can have good 4 ETFs around there in your portfolio. Now there are two concepts over here which I would talk about. First, the efficient market theory. What does this mean? It has been said that all the markets, not just equity markets, all the businesses, all the markets at certain point of time, they become efficient. What does this mean? See, inefficiency is, for example, when JP Morgan, I'm talking about the guy, I'm not talking about the bank, the guy who started JP Morgan, or Andrew Carnegie, or maybe Dhirubhai Ambani, or Mr. Birla, all these people when they started, or the, JRD Tata and all those people. So when they started, they probably had monopoly. So they exploited the inefficiency in the market and they got the advantage. But as and when the world progresses, India as a nation progresses, we can see clear competition, cutthroat competition amongst businessmen, and then a balance comes over there. And this is something which is also happening into equity markets. If you have seen in the last 15 years, the number of fund managers have increased, the number of PMS managers have increased, the AIFs have increased, hedge funds have increased, institutions has increased, and because of which efficiency is coming. And because of the same thing, it becomes very difficult for an individual entity to outperform. And that's why you can see a lot of differences. Because see, in equity markets, if you have to outperform with specific stock picking, first, you need to have great skills. Second, good knowledge. Third, you need to be upgraded, updated. And fourth, you should be really expert in understanding the mass opinions of the people, which keeps on changing every 10 to 15 years. So for example, the millennials or the Gen X, as we say, those who have entered the market in the last 1.5 years, who have been putting good amount of money out there, they have a different thinking. They believe even loss-making companies would work out well because Amazon did well. They believe that even crappy stocks would work out well because there is a high possibility there could be turnaround. And that's what you can see into the markets. Some random stocks also start performing. Why? Because this also becomes the responsibility of an efficient stock picker to understand what's going inside the minds of the people. It's very, very important. So with the efficient market theory, it's quite evident with the years to come, it would become difficult for a lot of active fund managers to beat. I'm not saying no one would be able to beat. I'm saying it would become definitely difficult. So that's there. Next, you need to understand one thing, that whenever you go for an ETF, there are two key areas you need to look for. One is the tracking error and another one is impact cost. The lower the tracking error and the lower the impact cost, the better is the ETF. So I would insist you guys to do this homework and find out your ETFs. Now you would understand what is tracking error. So let's take an example. I'm just giving an example. So let's say Yes Bank initially was there, a good part of Nifty 50, and there were a couple of other stocks also, but then they were thrown out of it. So how quickly that fund house is actually getting adjusted over there and is accurately tracking the Nifty. So if it is missing it out by a huge margin, then the tracking error would be more and it's actually not considered as a good thing. And impact cost is again related to liquidity. If the buyer and seller are too far-fetched, the impact cost would be higher, which is not good in terms of investment. So you need to invest only into ETFs which are having low expense ratio anyways in most of the ETFs is very low. STT, as I said, is negligible. No locking period, which is another advantage. In mutual funds you do have locking period. So now I would simply tell you what sort of strategy you can use. There are two prime strategies which people can use. One, you can either keep on doing a sip into ETFs every month on month with a thing that something called a dollar cost averaging method or rupee cost averaging method. That is something which you can do, which I've explained in the investing course already. And the second thing which you can actually do is a core satellite approach, wherein you realize that I believe into the stock markets, I believe into the entire economy. So I'm going to put around, let's say 70 to 75% of my major chunk out there into, the core stocks, and rest 25% I'm going to take some risky bets into mid cap, small cap, or anything. So 70-30 or 75-25 is the ratio which you can mention over there. Another thing which you got to understand, as I mentioned, that it's better to bet on the economy rather than just, wild sector. So the question would be then, when should we think of investing into infra Bs or these sectoral based, there are PSU Bs and all. That is precisely when you're not finding a competent mutual fund with less expense ratio. So let's say if there is one sector fund in the same segment, but its expense ratio is 2.5%, then you might think of going into these things. So guys, I hope now it is clear. So my quick suggestions to all the people: what to do if the markets are very high? Should we invest into ETF? Yes, but instead of 10,000, you invest 1,000 if you have the capacity to spend. What about the next 9,000? Just diversify it or keep it liquid for some time. Which is the best time to put into ETF? Anyways, every day is the best time. But my suggestion would be, you should always have some liquidity left around whenever there is a danger, whenever there's a deep fall, steep fall, whatever kind of fall is there, whenever there's some panic. So for example, every year you will find some event, some attack, some terrorist thing, and all those things. That is the best time when you should actually be ready with the cash. A lot of people have regrets, they don't have money at that point of time. So for example, when markets fell from 12,200 in March and came down to 7,500, the biggest regret for a lot of people was they were fully invested and they didn't have any cash to deploy. So although they became profitable, but even if they sat around, they made like 25-30%. Whereas if they would have extra cash, they could have made easily twice or thrice more than that. So I hope this session on ETF gave you some clarity. I'll be coming up with few more interesting this thing. Okay, and one last thing. In even US, a lot of people might be thinking that these FANG stocks, that is Facebook, Apple, Amazon, Google, all these things must be the most traded stocks out there. No, it's the ETF which gets the highest traded.